The current AI boom bears a striking resemblance to the dot-com bubble of the late 1990s, but with a twist that makes this frenzy potentially more dangerous. Just as the internet once captivated imaginations and drove valuations to dizzying heights, today's enthusiasm for artificial intelligence is propelling companies like Nvidia into the stratosphere. Investors are betting that AI will revolutionize productivity and reshape the global economy. In the late 1990s, the internet was hailed as a transformative force, promising to redefine every facet of our lives. AI is now cast in a similar role, poised to usher in a new era of technological advancement. But while both the internet and AI are undoubtedly groundbreaking, history warns that not all high-flying valuations are justified. Just as many dot-com enterprises crumbled despite their role in driving internet change, some AI trailblazers might also falter or see their values cut in half. Take Nvidia, for example. The chipmaker has been a major beneficiary of the AI hype, with its revenues skyrocketing to around $61 billion and its net income surging nearly 900% to about $30 billion. Investor excitement has driven Nvidia's stock to soar ninefold by July, boosting its market value from under $400 billion to an astounding $2.8 trillion. Despite the promise of AI, this meteoric rise suggests that valuations in the sector might be running ahead of reality, with potential for significant corrections ahead. So, in today's video, let's understand what happened during the dot-com bubble, so we can better prepare for the next stock market crash. The 1990s were a whirlwind of economic exuberance, fueled by low interest rates and a frenzy of investment in technology. As the internet sparked wild enthusiasm, it became the epicenter of speculative investments. Investors, captivated by the internet's transformative promise, eagerly threw their money at any company sporting a .com in its name. Many of these businesses, however, were little more than shiny ideas with shaky business models and no path to profitability. Amidst this frenzy, valuations reached absurd heights. Companies like Pets.com and the Globe.com experienced meteoric stock price surges, not because of solid fundamentals, but because of the unchecked belief in their future potential. The market was swept up in a speculative bubble, where the focus was on the promise of future riches rather than the reality of financial health. Economic bubbles burst forth when the market value of an asset wildly overshoots its real worth, typically stoked by unchecked speculation and reckless borrowing. The dot-com bubble is a classic example of this phenomenon, with investors driving prices to dizzying, unsustainable levels. This bubble draws a striking parallel to past economic disasters, like the Great Depression, where rampant borrowing and speculative fever created a volatile financial landscape. Both episodes underscore the perilous nature of letting speculation run amok, revealing the dangers of ignoring fundamental value in favor of feverish market excitement. Many internet companies were riding high on inflated valuations and shaky business models, setting up the perfect storm for the bubble's burst. By March 2000, the Nasdaq Composite Index, which tracked a myriad of tech stocks, had soared to its zenith before crashing spectacularly. The aftermath was a financial bloodbath, with massive losses, a slew of bankruptcies, and a broader economic downturn worsened by the September 11th attacks. While the crash wiped out substantial wealth and led to the collapse of numerous dot-com ventures, it also acted as a catalyst for the internet's maturation. This tumultuous period fast-tracked technological advancements and laid a solid foundation for the digital revolution that would follow. The dot-com era, a period marked by frenzied investment and sky-high valuations, offers valuable lessons for today's tech industry. During this time, companies like Netscape and Priceline captivated the market with their soaring valuations despite not yet turning a profit. Investors were drawn to their rapid growth and the tantalizing promise of future wealth. However, this enthusiasm often overshadowed the lack of solid financial fundamentals. Today's tech landscape has evolved from those heady days, with a stronger emphasis on balancing growth with sustainable business models and real profitability. The continued success of companies like Amazon and Apple highlights the importance of maintaining this balance between explosive growth and financial stability. The dot-com bubble was characterized by extreme overvaluations. Companies such as Pets.com saw their stock prices skyrocket despite having shaky business fundamentals. This rampant overvaluation was driven by the excitement surrounding the potential of the internet, rather than by solid business metrics. In contrast, today's market, while still witnessing high valuations, is marked by a more discerning approach. Investors now place greater importance on solid financial metrics and robust business models. Companies that demonstrate real financial health and sustainable strategies are better positioned to thrive, reflecting a more mature and cautious investment climate. Speculation was another hallmark of the dot-com frenzy. Investors flocked to initial public offerings, IPOs, without fully understanding the inherent risks, leading to massive losses when the bubble burst. Although speculation persists in today's market, there has been a significant shift towards more rigorous regulatory frameworks and a stronger emphasis on due diligence. Investors are now better informed and more cautious, though high-risk ventures continue to attract attention. The evolution in investment practices reflects a broader understanding of the need for careful analysis and prudent decision-making. The infrastructure investments made during the dot-com bubble, particularly in internet technologies like fiber optic cables, initially created an oversupply of capacity. However, this surplus eventually proved to be a boon for future technological advancements. The infrastructure laid down during this period now supports today's digital economy, underpinning services such as streaming, cloud computing, and social media. What was once considered excess capacity has become the foundational backbone of our modern digital world, demonstrating how seemingly redundant investments can drive significant long-term benefits. The dot-com crash, while causing substantial wealth loss and company failures, also accelerated technological progress and infrastructure development. The upheaval of that era set the stage for crucial advancements that have shaped the current digital landscape. Today's market is more stable, yet it remains vulnerable to potential corrections. The painful lessons learned from the dot-com era have led to more prudent practices and cautious investment strategies aimed at avoiding a repeat of past mistakes. In the aftermath of the dot-com crash, some companies, like Amazon and eBay, not only survived but emerged stronger. Their success was fueled by robust business models and visionary leadership. These survivors have demonstrated that adaptability, innovation, and strategic foresight are essential for navigating the ever-evolving tech market. Their continued prosperity underscores how a solid foundation can transform adversity into opportunity in the dynamic world of technology. The dot-com era, with its mix of exuberance and folly, provides crucial insights for today's tech industry. Balancing optimism with a thorough understanding of business fundamentals is vital. Patience, careful analysis, and a cautious approach to speculative risks are essential for navigating the tech sector successfully. The advancements and infrastructure from the dot-com bubble have laid the groundwork for today's digital economy, illustrating how economic upheavals, despite their challenges, can catalyze significant progress and innovation. And that's all for today's video. So, if you enjoyed the content, please feel free to hit like and subscribe button to support the channel out. With that, this is Visionomics, signing out.